fundamentals, draw on liquidity, old highs, lows, and imbalances. The video layout is a little different because I had to re-record it, so don't mind too much, it's gonna fit perfectly in. So what do I mean with the draw on liquidity? Well, we need to know where price is going. And it's never sure, of course, this is never 100%, but we can analyze the charts based on different time frames and conclude where price wants to go first to liquidate positions, grab liquidity, and then possibly change direction or continue. Accumulation, manipulation, distribution. So the drawing that I'm gonna make now, many of you will have seen that before. And why do I do this like this? Because I want to show you guys something. If you see the market do this, then there was probably an imbalance here where the market had to return to take the liquidity out of this position. Why? Because it wants to continue in its original direction. And why does it go grab this liquidity? Because in this case there will be a lot more buy orders here, like buy limits, people that want to enter a market execution position, and people that even gonna enter when the market comes back down with new buy stops here or above this high. And why does the market move like that? Well, the market is always looking to get money into the system. And you see this position, there are people shorting here. There's people going short here. And there were people going short here. So all these stop losses are also liquidity. Let me grab this quickly. There is liquidity in this stop loss too. So the market will now, in the draw on liquidity, will be these stop losses. So the market is gonna continue up and go after all these positions to push probably even higher. But in case there is a reaction that happened here on an old bearish fair value gap or an imbalance, then price could possibly have a second reaction here. Why? Because there is new liquidity created below here and below here. So here we create a double top, maybe even another return, and then we have another drop down again into this liquidity, because there will be a new smaller time frame imbalance created here. And price just goes back to pick up those orders and then goes back after these orders and possibly take out then the highs. And why do I say this? Because this now are relative equal highs, and that works as a magnet on price. So price will go after this and that high, and because there are more positions now with stop losses above these highs, price is gonna convert these orders, these stop losses, when they are hit, they convert in a buy, stop, or a market execution. So price then will tend to go down a little bit and even move up higher. Now, it all seems a little far-fetched, but if you see how it really happens during the day when positions are being taken out and in the market, then you know that what I'm saying is real. These are all fractals. So in these fractals on lower time frames, we will see that price was doing actually this. It creates more liquidity. And price is based on what? On time, especially, and then on liquidity, because price moves first based on time. That's why most traders like me, we respect certain kill zones. It means we won't take a trade outside certain time frame. Like my time frames, for instance, are between 10:30 and 11:30 are my best positions in the morning. UTC +1 for the moment means Europe. And in the afternoon, when New York opens, most of my positions, I'm gonna find them between 3:30 and 5. So it's a very small time frame to interacting with the market. And the beauty there is, the more you stick to your plan, rules, and your setups, and you know when they play out best, instead of becoming or being liquidity, you get liquidity out of the market. That was this for this video. I hope you guys learned something from it. And definitely check out my other videos, and thanks for watching.